I've long held that the IUL is the very best cash value life insurance alternative when it comes to building wealth and then distributing it tax-free in retirement. Others within the industry insist that whole life has more reliable and predictable cash value growth and is therefore the better LIRP alternative when it comes to tax-free retirement. Now, before I react to this, I have to say that unlike some personalities in the industry, I'm not a product purist. I don't hate whole life in the way that some people hate IUL. I'm not a debase one product in order to exalt another product sort of a guy. I think that both IUL and whole life have their place. I just believe the IUL is far superior when it comes to accumulating tax-free wealth and then distributing that wealth in the most efficient way. Now, clearly, the main reason whole life advocates prefer whole life over IUL is because your cash value is guaranteed to increase each and every year. The cash value in your IUL, conversely, has growth that is generally tied to the upward movement of a stock market index. Whatever the stock market index does, you get to keep up to a cap, typically between 10 and 12%. If there's ever a down year, they simply credit you a zero. And this is the aspect of IUL that scandalizes whole life advocates. Why? Because the proposition involves some risk. The risk that during a down year, a year in which your account gets credited zero, you're still going to be paying for the expenses within your IUL. So technically speaking, your cash value could go negative in any given year. There's no guaranteed increase like in whole life. So I get it. You're looking for predictability in your LIRP. Maybe you can't stomach a year in which you not only get credited a zero, but still end up having to pay those expenses. Now, I still think the IUL will more than make up the difference for those flat years over time, but I'm willing to indulge this concern. To address this objection, I decided to run an illustration where I allocated all premiums to the IUL's fixed account. The reason I did this is because it eliminates the primary concern that whole life advocates have about IUL, namely those flat years where you still have to pay those expenses. By allocating the premiums to the IUL's fixed account, you will have a steady, consistent rate of return that is not tied to the upward movement of a stock market index. You will never receive a zero credit. So your cash value, assuming non-guaranteed mortality costs, will always be moving in a positive direction. In other words, by allocating your premiums to your IUL's fixed account, you can recreate all of the attributes of the whole life policy inside the IUL only on a supercharged basis. After creating my IUL illustration using the fixed account, I then tried to mimic the same approach within the whole life policy. But before I get into the variables I use in the comparison, a word about the companies I used. I don't generally like to discuss names of companies on this channel, but suffice it to say, I utilize what my whole life peers tell me is the best company when it comes to cash value buildup. On the IUL side of things, I utilize one of my two go-to companies when it comes to my own clientele. If you want to know the exact companies I used, you can email me directly at info@powerofzero.com. So here's the comparison. With both products, I showed a 40-year-old male, second best underwriting class. He's contributing $20,000 per year from age 40 through age 65. Then I showed maximum loans from age 66 to age 100. In the IUL, I used a standard 0% wash loan, no arbitrage involved. The whole life policy showed the current dividend scale, while the IUL's fixed account is crediting 5% per year. Now, we know that the 5% rate in the IUL's fixed account can change every year, but so can the dividend on the whole life policy. Both products generally respond to the ebb and flow of interest rates in the same way. In either scenario, we got as little death benefit as the IRS required of us in order to contribute that full $20,000 per year. Again, the goal was to see which alternative gave us the highest loans in retirement, the whole life policy or the IUL with a fixed account allocation. Okay, let's begin by looking at the whole life policy. Starting at age 66, this produced a loan of $42,675 every year until age 100. That's cumulative distributions of $1,493,625. Now let's take a look at what the IUL with a fixed account allocation is able to distribute. Starting at age 66, it produces a loan of $48,084 every year until age 100. That's cumulative distributions of $1,683,940. In other words, if what you're looking at is purely maximum loans at the back end, then the IUL distributes $189,315 more than the whole life policy over that 35-year distribution period. Now, what accounts for this difference if both companies are generally investing in bonds? Well, it's hard to say because whole life doesn't really tell you what the expenses are. It's the whole idea of the black box of whole life insurance. You just don't know what's happening internally to produce the results that you're getting. However, I suspect that the reason why whole life lags is because of fees and the loan provision. The IUL loan provision, conversely, is guaranteed to be 0%. That means that your loans will always be tax-free and cost-free. Whole life policies don't have guaranteed 0% loan provisions. There can generally be a difference between what the company charges you on your loan and what they credit back to you in your loan collateral account. So even if you allocate all your premiums to the fixed account inside the IUL, your growth in loans will still outpace an equivalent approach inside the whole life policy. But having said all of this, I have to emphasize that you wouldn't want to use an IUL for its fixed account. You could, but it could be a costly mistake. Even more costly than using whole life as the cash value life insurance component of your tax-free retirement plan. Let me give you a sense for how much your loans on the back end might increase if you simply tied the growth of your cash value to the upward movement of a stock market index up to a cap. So in this next projection, I'm growing the IUL at 7% instead of 5% in the fixed account. I'm showing 7% growth because that is what this particular company has been able to generate over time. And if I'm confident enough that the company can continue to get that extra 2% over the life of the program, then the benefit can be massive. Take a look. Instead of taking tax-free loans of $48,084 every year, I can now take out $100,100 every year for 35 years. That's a cumulative total of $3,503,500. That's $1,819,560 more than the IUL in the fixed account and $2,009,875 more than the best case scenario for the whole life. So by moving yourself just slightly to the right on that risk continuum, by tying your growth to a stock market index up to a cap instead of the IUL's fixed account, you can more than double your loans and generate $1.8 million of additional cash flow. In summary, what I've shown you today is that by allocating your premiums to the fixed account inside a maximum funded IUL, you can generate more income than you would inside a maximum funded whole life policy. Further, by taking just slightly more risk in your IUL, by tying the growth of your cash value to the upward movement of a stock market index up to a cap, you can more than double your annual tax-free distributions. And that's why I generally advocate this approach when it comes to the cash value life insurance component of my clients' tax-free retirement plans. If you want to learn more about how to incorporate index universal life insurance into your tax-free retirement strategy, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is Dave McKnight. I look forward to seeing you on the next video.